then capital market line, and finally we are going to consider this capital market line with security market line.
Excuse me,
right? Yes, Kudam.
so sometimes we cannot hear properly, so there's some disturbance. As I said, line is not stable.
Okay, fine. Yes, Dayan, can you hear us now? And is it visible?
Yes, sir.
Right, okay, sorry. Right,
Thanks.
so first and foremost, let's discuss about the introduction part to the risk and return concept, right? So now here it says the risk and return are most important concepts in finance, right? Now, you know, when it's come to determine the value of a security, we are basically looking at the expected cash flows and the risk associated with those cash flows. So simply, we are targeting on the risk and the return. The expected cash flows mean the return that you are going to get, right? And also, when you are going to do investments, these are some of the fundamentals that you are considering before you do investment. You need to do a lot of analysis, fundamental analysis, technical analysis, and many things. Yes, of course, together with that, you are looking at the risk of your investment, right? You are looking at the return that you are going to get out of that risk, particular investment. And you are sometimes trying to match with whether you are getting a fair return for the risk that you bear, right? So accordingly, it's a very important concept when it comes to the finance, because we mainly focusing on shareholders. Shareholders are expecting a return and they may have a risk as well, right? And the foundations of the SDA, right? So you know that there are several models, two-factor model, three-factor model, four-factor, five-factor models. So the basis for such model is very clearly this risk and return concept. Now, yes, these are the two things that I said to you earlier. How assets are valued in the capital markets. You know, simply we get the present value of the future cash flows. That is how we value an asset, right? So your future cash flows is your return, and you need to discount your future cash flows to get it into the present value. The discount rate is the risk, simply the cost of capital, right? Simply the cost of capital. And investors, they mainly focusing on this particular risk and return when they do their investment, because they invest their hard-earned money. Accordingly, they need a fair return, right? Not a higher or a lower. Simply in finance, we say they require a fair return for the investments, right? So that is the importance of this risk and return concept. So let us look at some of the return concepts, right? Now, if you say return, there are many types of returns. We have geometric returns, average returns, then expected returns. Many categories of returns are there. Right now, the first one is we call it as return on a single asset. Right, return on a single asset. Simply, if you have invested in a share, you are getting the dividend and the capital gain. Right, you are getting the dividend and the capital gain. We call it as dividend yield plus capital gain yield. So we have completed that part. Then the other category is average rate of return, right? Average rate of return. So which means for consecutive years, you may have several return series. You are going to divide the summation of those return from the number of years, right? For an example, let's say in year 2019, the return is 19%. 2020, the return is 20%. 21, the return is 21%. So you can easily calculate the average rate of return by summing all these, right? And dividing by the number of years, right? Divided by the number of years, right? So this year value plus this year value plus this year value, that is the sum. Then you are going to divide it by the number of years. Then you could see what is the average return, right? Average return. So we are going to calculate these things, right? So here it says the average rate of return is the sum of various one period rates of return divided by the number of periods, right? Number of periods. Sometimes within a year, you may have 12 months, you may have 12 return series, then you have divided by 12. Okay. Then the other one is historical returns, right? So simply historical return mainly captures the past returns, right? Past returns, right? So actually this is a past return. This is an example for past return. Now we are in 2023. These are the past returns. So here it says the historical return of a financial asset such as bond, stock, security, index or fund is its past rate of return and performance. What is the previous returns of John Keel's shares? So once we look into that, we are specifically looking at historical return part. Right. So usually return consists with two things, dividend plus capital gain, or we call it as dividend yield plus capital gain. Then we have another return component, we call it as average rate of return. Averagely, we are looking at what is the return of that particular company, right? 2019 to 2021, we are getting the sum and we are dividing by number of with the sample size, or by the sample size. Then the historical return means previous returns, right? Example is this. Okay. Now there is something called expected return. Now, if you say expected, what is it implying? Future, present, or past? Once you say expected, it's future, right? So when it's come to the future, what do you think? Can you get the exact return that you expect or not? What do you think? Generally, you expect to get a 15% of return by investing in ABC company shares. Can you get that exact 15%? I'm asking 100%. Could you say, yes, you are going to get that 150% return? You can't, right? You may get, but there is a risk associated with it, right? So when it's come to the expectations, always we are dealing with probabilities, right? Because future, sometimes we can predict, sometimes we can't. Okay, so if we can predict, it's risk. If we can't predict, that is uncertainty, right? Uncertainty. So when it comes to the expected returns, we are looking at the returns that we could generate in future from our investments. So we are assigning probability values, then we are calculating something called expected return, right? Very simple, expected return. So here you could see the expected rate of return is the sum of the product of each outcome and its associated probabilities. That's a little bit difficult to understand once you look at this particular definition. Let's go to an example, right? Let's go to example here. Now, here you could see that rate of return under various economic conditions are there in a high growth situation, expansion situation, stagnation situation, as well as declining situation. Okay, so this is the share prices and the dividends. Thereby, you can see the dividend yield as well as the capital gain yield, right? Dividend and the capital gain. So the final column indicates the total return, right? Total return consists with dividend yield plus capital gain yield. Right? So usually we are expecting these two, no? Right? If we have done an investment, we are expecting these two, dividend and the capital gain, right? So in a high growth situation, you are expecting a return of 18.4%. Clear? In a high growth situation. In expansion situation, you are expecting a return of 10.5. In a stagnation situation, you are expecting a return of 1%. Whereas when it comes to the declining situation, you are expecting a return of nearly negative 6%. Right? Negative 6%. Is it clear? Right. Now, these are the return that you believe that you would generate. Right? So, if you look at this second table, you could see these are the returns that we have calculated, but there's a probability. Right? There's a probability. So here the design probability value is 25. So once you multiply your return with the probability and the final answer, we call it as expected return. Right? Expected return. You have the return series, then you are going to multiply it with the probability, right? The answer that you get, we call it as expected return. Right? Expected return. Very simple, lah. Return multiplied by the probability. So that is why here you observe that it says the expected rate of return is the sum of the product of each outcome and its probability. Right? Each outcome and its probability. Sum of the, right? So this is the sum and this is the return, and you are going to multiply it with the probability. Right? Return, you are going to multiply it with the probability. Is it clear? Right. So could you please read up to this point after that we can start doing calculations. So please read up to that point. So usually you are getting a question from this question return in your field. Like question number 304 is from question return, right? So first two ways in some this particular question usually takes to 18 is to usually they score better marks out of 18, they score 12, 13. That's good. Average, yeah, average. Average. So the issue comes when it's come to the portfolio. Right? Issue comes when it's come to the portfolio. So these are okay, right? Expected rate of return, variance, risk is okay, but so we need to focus more on these portfolios, isn't it? Portfolios. Right? Okay, clear? So what are the things that you have learned up to now? You have learned the importance of risk and return. Then we discuss about types of returns. In there, you observe, yes, normal return part is that is dividend plus capital gain. Then we have the average rate of return, historical returns, and the expected return. Okay, so we'll do a question. I think online students, I think you can see this.
Yes, sir.
Right. Okay, so let's look into this. Very simple, huh? Very simple. Okay, so here it says now what you have to do at the end. So you know how to approach a question, right? So assume this is a question that comes to your examination. First, you have to read the required part. Right? First, you have to read the required part, and it says calculate the expected rate of return, calculate the variance, and calculate the standard deviation. Right? So these are the three things that you have to do. For the moment, we know how to calculate the expected return, but other two still we don't know. When I'm doing this particular question, I'll explain it as well. Right? Okay, so you have to calculate the expected rate of return, variance, and the standard deviation. So let's read the question. So here it says the management team of FZR PLC, right? FZR PLC. Actually, I don't have names for the companies, right? So plenty of names are there, right? Then, but the management team of the FZR PLC, this is an exam question, huh? One part of the in one question, huh? Right? The management team of FZR PLC has analyzed the returns for their stocks in three different economic conditions. The company believes that they could secure a return of 20% if the economy grows, whereas they assure that the returns will be 50% under the expansionary situation of the country. However, the company attempts to secure at least a return of 5% if there is a declining trend in the economy. Right. So these are the returns that they believe that they could generate during three economic conditions. Now you could see when the economy is growing, right? When the economy is growing, they are expecting right? They are expecting a return of 20%, right? They are expecting a return of 20%. Then when the economy is under expansionary situation, right? Expansionary situation, they're expecting a return of 15%, right? They're expecting a return of 15%. And when the economy is declining, right? When the economy is declining, they're expecting a return of 5%. Okay, they're expecting a return of 5%. Then the financial analyst of the company has come up with probabilities of 50%, 25, and 25 respectively for the above three economic conditions. All right. So these are the returns that they believe, but there's a probability associated with it. How much? It's 50%. Here it's 25%, and here it is again 25%. Right. So these are the probabilities. Okay. So now what you could do, you can calculate what? You can calculate the expected return. Very simple, right? You can calculate the expected return. How? If I mention this is as your A and this as your B, simply Buddha, you need to multiply your A column, values of the A column with values of the B column. Simply you have to multiply your return with the probability, right? Return with the probability. Yes, what is the return when it comes to the growth part of the economy? 20 multiplied by 20% multiplied by 50%. Take out your calculators, 10%. 10%, right? Okay. 10% here. 15 multiplied by 25%. 3.75%. Okay. Then declining situation. 1.25. 1.25. Yes. Online students, are you all okay? Online students?
Yes, sir.
Right. So accordingly, the summation is how much? Summation is how much? 13, 14, is it 15? 15, right? Right, okay. So expected return, right? Expected return equals to 15%. Expected return equals to 15%. Very simple, right? Which means these are the returns that you expect in these three economic situations, but there's a probability, right? So accordingly, this is the expected return, right? Expected return. Simply you are multiplying your return with the probability. Okay, right. Then we have to calculate something called variance, right? So you know risk and return, right? Risk and return, two concepts coming together. Now we have calculated the return, then we have to calculate the risk of this investment, right? We have to calculate the risk of this investment, and usually we calculate the standard deviation uh, to get an idea about the risk. But before we calculate the standard deviation, we have to calculate the variance, right? So that is why we calculate the variance before we are going to calculate the standard deviation, right? What is variance? We have done statistics, isn't it? What do you mean by variance? Variance means what? Calculation is okay, right? Anyone can do the calculation, doesn't matter. What is variance? Yes. What do you mean by variance? Practical understanding, on the theoretical part. Variance means what? Yes. Yes. What difference? Huh? Yeah. Okay, correct. Variance between the E, that is correct. Okay. Then right now, okay, fine, good, good. Tamara answers the okay, fine. Now let's say before calculating these returns, let's look at marks. Let's look at marks. Now, so let's assume that for your business economics, the average mark was 65, right? Average mark was 65. I know it's more than 85, but did you get your business economics marks? Still not. No, no. For an example, let's say, right, 65, right? Okay, 65%. Let's assume average mark is 65, right? And there are 5 students in this class, right? There are 5 students in this class. Okay. Now one got 80, right? One got 80. Another student got 45, right? Another student got, let's say, 70, and the other one 53, right? So once you get the average equals to 65. So definitely the answer is wrong because we have just hypothetically indicate this well, right? So this is your mean, right? This is your mean. Then the distance from mean to individual marks, right, is known as what? The difference, right? Is known as the difference. Now this is your average mark, and you have obtained 45, right? So what is the difference between your mark and the average mark of the class, right? Average mark of the class. Right now here, this is 80, 65. So what is the difference? He got 80 and the average marks of the class is 65. You can get the difference, right? This is what we known as variance. Then here, he got 45, but the average marks of the class is 65. Now, here you are going to get a positive value, but here you are going to get a negative value. Understood? We cannot calculate the variance using even in the Excel also with negative values. Then what you should do? Right? So simply, we have to do like this. Right? We have to do like this. So accordingly, what happened? Both values are positive. Clear? Right? So variance means simply the dispersion or the difference between the mean value to the individual point. Right? So you are doing this kind of a mathematical operation because you are going to get a negative value. Clear? Are you all okay? Right. So based on that, let's calculate the variance of this particular question. Right. So now we are going to calculate the variance. Right. Variance. This is the symbol for variance. Huh? This is the symbol for the variance. Right. This is the symbol for the variance. Online students, you all are with us, right? Online students.
Yes, sir.
Right. Okay. So now we are going to calculate the variance. Right. This is how we do it. 10%, right? Minus 15%, right? 10% minus 15% to the power 2, right? To the power 2, then plus 3.75 minus 15% to the power 2, then 1.25 minus 15% to the power 2, to the power 2. Right. Ah, we have probabilities here, no? Right? Just a moment now. You have to multiply it by the relevant probability. Extremely sorry, yeah. You have to multiply it by the relevant probability. Sorry, yeah. Extremely sorry. Right? Right. So this is your expected return, right? Expected return. And yes, right? So we have to take this, not this, right? Your individual return minus your expected return to the power 2, right? To the power 2, and the associated probability of this is 10%. Plus, under the expansion situation, it's 15 minus, it's 15, right? Multiplied by 2, multiplied by relevant probability, it's equals to 25%. Then again, here, 5%, the expected return is 15%, and you have to multiply the relevant probability, it's 25%. Right? Individual security return minus expected return, you need to get the 2 to the power of it, then multiply it by the relevant probability. All right, probability is 50%. Sorry, probability is 50%. Yeah. Thank you. So you all address nicely today the official addresses because you are going to have the presentation for it by explain. So what's the topic? So what is your it's also a topic. Is there? Right, so what is the variance? Variance? Yes, your variance equals to yes, variance equals to variance equals to 0.375%. Is it 37.5%? 37.5%, right? Yes, what is the answer to that? Now, this for the second one, you don't have an answer, isn't it? For the second one, you don't have an answer because it's zero. Yes. How much? 3.1. Yes, online students, what is the answer? Variance equals to how much?
It's 0.38%, sir.
0.38%.
Yeah.
Right. So isn't it 38%?
No.
Okay. So it's simply 0.38%. Clear? All of you? Correct? Okay. Fine. Yes. Right. So the variance is equals to 0.38%. Right. Then what we could do, now we can calculate the standard deviation or simply the risk. Right? Simply the risk of the security. Right? So how we do it, we are going to get the square root of the variance 0.38%. Can come up with the answer. How much? Six one. 0.61. Yes, online students 0.61. 0.61%, right? And so you have to be very careful when you are doing the calculation on decimals, percentages. But anyway, the final answer is this. It's okay. Right. Is it okay, online students? We have calculated the expected return. That simply we multiplied the return from the probability. Then we get the summation. That is what we call it as expected return. Then we have to calculate the risk. But before we calculate the risk, we have to calculate the variance. That's simply the variance, how your value differs from the mean value, right? How your value differs from the mean value, right? So this is how you get it. Then we are going to get the square root of the variance. Accordingly, you can calculate the standard deviation, right? Now, one thing that you want to know is now all these are future values, right? All these are future values. Accordingly, this is the way that we calculate the variance. But if you calculate the variance for the past value, you have to divide everything by n minus 1. Right? You have to divide everything by n minus 1. That's the point that you have to learn, right? This entire one, if it is a past value, you don't have probabilities, right? If it's a past value, past return series, definitely you don't have probabilities because probabilities are associated with the future, right? So then this entire part must be divided by n minus 1, number of years minus 1. Clear? Okay. Then are you okay with this? Clear, online students? Are you okay?
Yes, sir.
Right. Fine. So now you know the expected return, right? And this is the formula for us to calculate the variance, right? This is the formula for us to calculate the variance. This is what we did. And you are not going to get the formulas for the examination. Variance is easy, you know. But portfolio return, portfolio risk, such equations will be given. Right? Okay, so this is how we calculate the variance of a security. Then risk concepts. Actually, we have calculated the risk. Right? We have calculated the risk here as well. But we have to learn about this. Right? We have to learn about this. Now, right? So simply you know how to calculate the risk. It's a matter of getting the square root of the variance. Clear? It's a matter of getting the square root of the variance. But here it says, if you are calculating the variance for the past returns, the entire part must be divided by n minus 1. That is what here it says. But if you are using it for the future values, no need to divide it by n minus 1. No need to divide it by n minus 1. Right? Then the standard deviation you are calculating by using the square root of the variance. Right. Now here you could see this is the normal distribution. Right? This is a normal distribution. What does it say? What does it say? Huh? Yes. What normal distribution says? Yes. What normal distribution says? Yes. Business statistics. I'm just asking what does normal distribution illustrate? It's like a mountain, isn't it? Like a mountain, right? So yes. What do you think by you? Right. Okay. So it's like this. Yeah. Any idea about normal distribution? What? Right now, for an example, let's say, forget about these stock market returns, everything. Right. For an example, let's say, if you consider about your marks, right? For an example, let's say marks for the business economics, right? Let's say it is normally distributed. Clear? It is normally distributed. And this is the mean value. For an example, let's say mean value is 50. Mean value is 50. And here 75. Here for the moment, let's assume 40. Right? Which means there are fewer number of students who got A passes and fewer number of students who got below 40 marks. And the majority in between this range. Clear? The majority is in between this range. So this is simply what normal distribution is, as you mentioned, equally distributed. So you need to know what, right? Equally distributed. If you consider about marks, now the marks are equally distributed, right? Marks are equally distributed. So if the marks could be like this, it tells a different story, right? And if the marks like this, it tells a different story. Why here it's more towards on the higher angle. Here it's more towards on the lower angle. That's why I'm not going to explain these two using the marks. I'm not going to explain these two using marks. please consider only this. Right? So simply normally distributed. Now, when it's come to the finance, most of the research, we assume that the returns are normally distributed. Right? According to the Markowitz portfolio theory, we assume that returns are normally distributed, but still we are checking whether it is normally distributed. Right? Still we are checking whether it is normally distributed or not. Right? So this tells you, right? Simply this tells you the variance and the risk. The mean value is this. Sometimes your mass could be here. So it tells the variance as well as the risk. And there you could see, in explaining the risk and return relationship, we assume that the returns are normally distributed, which means some returns are higher, some returns are lower, and most of the returns are average. Right? So it's a fairly distributed. Okay? If you consider about your marks, there are 10 students who obtain more than 75, 10 students who obtain more than 40, and the majority obtain 50. So it's good, right? So it's good. Then the spread of the normal distribution is characterized by the standard deviation. Spread means the difference of the individual values from its mean value, like we explained earlier, right? We call it as standard deviation. So normal distribution is a population based and a theoretical distribution. Right? It's a population based. You illustrate this using the population. Right? So simply I proceed to explain the normal distribution, and our main target is risk. Right? Our main target is risk. Okay. Right. So what are the things that you know up to now? What are the things that you know up to now? You know the importance of risk and return. Then you got to know about types of returns. So usually their return consists with dividends and the capital gains. Then we have some sort of returns called average rate of returns, right? So you are going to get the different returns and you are going to divide it by the sample size, right? Then the other one is expected return. You are going to multiply your returns with the probabilities because you are considering on future. That's why we are bringing that for probability part to there, right? Then you got to know how to calculate the risk. What is risk? How to calculate the risk? Before calculating the risk, we have to calculate the variance. Clear? If the returns are for the previous years, and when you are calculating the variance, entire part must be divided by n minus 1. If it is for future, no need to divide it by n minus 1. Clear? Right. Okay. So now we are going to start with portfolios, right? We are going to start with portfolios, very simple part, but you need to provide your more attention to here, right? Now, what is a portfolio? Okay, how many mobile phones that you have? 2. Right? Now she is having 2 mobile phones, which means portfolio. Portfolio phones. How many motor vehicles that you have, including bikes and all? Yeah. One or two? Only one, okay. Single security, right? So which means if you have done more than one investment in a very simple way, right? If you have done more than one investment, we call it as a portfolio. Right? If you have more than one investment, we call it as a portfolio. So why usually you have more than one investment? Well, to mitigate the risk. Right? Sometimes we don't know whether we are mitigating the risk. Since the availability of investment opportunities are available, you go and invest. Right? Actually, the practical aspect is to minimize your risk. Right? So the normal simple theory is don't put all the eggs into one basket, isn't it? That's the basic here. Right? So accordingly, if you have more than one investment, we call it as a portfolio, right? Why you are going to go with the portfolio with the purpose of minimizing the risk? How your risk is going to be minimized? If one stock doesn't perform, if other stock performs, the losses will be minimum, right? The losses will be minimum. For an example, during the COVID period, right? Best example, you may have invested in hotel chains, and simultaneously you have invested in hospitals, right? So hotel chains, they had a drastically decline, but some hotels perform which is centers, but not based on the operating activity flow, right? So here the hotel sector collapsed. Accordingly, your return drops, but the hospital sector performs. Accordingly, the net impact would be loss minimization. Right? Altogether, it could be losses, but the losses were minimized. Right? The losses were minimized. So essentially, that is why you are going to go with the portfolio. Now here it says a portfolio is a bundle or a combination of individual assets, so securities, not only shares. If you have a apartment in New area, if you have a car, if you have land, right? So all are your portfolio, right? All are your portfolio. So portfolio theory provides a normative approach to investors to make decisions to invest their wealth in assets or securities under risk. So this particular aspect provide a good opportunity for the investors, right? Because you are going to put your hard-earned money to different investments. So accordingly, you need to minimize your risk. Okay. The return of a portfolio, yes. Okay. So here it tells about the return of the portfolio, and here it tells the risk of the portfolio. Right. I'm not going to elaborate this because when we do the calculation, I'll explain it. Here it says the risk of a portfolio would be less than the risk of individual securities. It's obvious. No? If you have one investment, if it collapses, nothing. But if you have two investments, if one collapses, you get something. Accordingly, the risk is lower. Accordingly, the risk is lower. And this is how we calculate the return of the portfolio. Don't look at this. Don't look at this. Right. So we'll go for a question. Right. We'll go for a question. Right. Yes. I think online students, you also can see this. Okay. Question number 2. What you have to do? We have to calculate the expected return of each investment. Then you have to calculate the standard deviation of each investment. Then you have to calculate the expected return for the portfolio combined with equal weights. Right. So we'll see how we could do it. Now you know how to calculate the expected return and variance, right? So could you please calculate this for these two companies quickly? Expected return and the standard deviation. Please calculate it. Expected return and the standard deviation. Yes, what is the expected return of micro PLC? Yes. Yes, what is the expected, yeah, expected return of micro? Then the expected return of macro. 11%. Expected return of macro is 11%. Expected return of macro is 20.5. Right? So expected return of micro PLC is 11%. And the expected return of macro PLC is 20.5%. Then what is the variance and the standard deviation? Variance is how much? Percent. 1.0, 1.036%. Then the variance of the macro PLC, variance of the macro PLC. These online students, did you get this answer? Variance of the micro PLC as 1.036%. Yes, what is the sanity? Sorry, what is the variance for the macro PLC? Variance of the macro PLC. One point. 1.747%. Okay. Then the standard deviation. Now this is the variance that you got. So when you are going to get the square root, you need to indicate this as a decimal, right, in your calculator. Then the final answer must be multiplied by 100, right? Final answer must be multiplied by 100 to get the percentage. Yes, the standard deviation equals to multiplied by 100 to become multiplied by 100. How much? 1017. Percentage, okay, here. Zero point 132 after multiplying by the 100, right? Okay. Yes, online students, did you get these answers? Online students, did you get this answer? Yes, Janaka, are you there? Janaka. Dayan?
Yes, sir.
Yes, did you get these answers? Is it correct?
Still not got the final answer, sir. Still calculating.
Okay. Right, so here you all get this answer clear, correct? Variance and the standard deviation, is it okay? Fine. Right, yes, variance. You can do this entire calculation for 3 hours. Right, in your paper. Yes, what is the variance? How much is it? Nobody speaks. What is the variance? Yes, variance put up. One point zero zero three. 1.04. 1.04. 1.04. But you all took these values as the isn't it? Right? 1.0.1, 0.036. Sorry, 1.036%. Then decimal. Decimal actually not one point zero zero three six. 1.036. Okay, yes, Buddha, what's the answer? This first answer, final answer 1.036. Gold and green. Is what the answer. Yes, what is the answer? Variance equal to. Yes, online students, what is the answer that you got? Yes, Janagar. Other one. Other one, are you there? So we are struggling here. Yes, other one. Yes, your variance as a percentage. Okay, finally. Right, yes. Variance as a percentage equals to 1.036. 1.036. 1.036% could be different from your answer, but you know how to get it, right? Individual security return minus expected return, get the 2 to the power multiplied by the probability, do it for the entire one, get the summation. The answer is this. Okay. Then the standard deviation. Standard deviation. Standard deviation. Yes, the square root of the variance, and the answer is 1.01%, right? Is it correct? Right. Okay, then the variance of the macro BLC. Variance of the macro BLC. Yes, variance 1.747%. Okay, then the standard deviation. 1.32. 1.32%. Okay, so answer could be different. It could either be because of the decimal changes or whatever. You know how to get it, right? Okay, so you have calculated the expected return of each share. You have calculated the variance and the standard deviation of the risk of the each share, right? Okay, so calculate the expected return done, calculated the standard deviation done. Then you have to calculate the expected return for the portfolio with equal weights. With equal weights. Now, please look into this carefully, right? So now here we assume that we have done the investment in micro PLC separately, macro PLC separately, right? But now what happens as an investor, right? You are going to invest your wealth, right? You are going to invest your wealth in both of these companies, micro PLC as well as macro PLC, right? As an investor, you are going to invest your wealth in macro as well as micro PLC, right? So your wealth is 100%, which means the amount that you have for your investment, right? The amount that you have for your investment. Now, according to this question says with equal weights, which means You are going to invest 50% of your wealth in micro BLC as well as 50% of your wealth in macro BLC. Right? You may have 100 rupees with you. Out of that 100 rupees, 50 rupees for micro, 50 rupees for the macro PLC. Accordingly, you have to calculate the portfolio return. Now, this is a portfolio. This is not a portfolio because you have individually invested micro PLC for a certain period, after that macro PLC. But now you are going to do the investment simultaneously. Right? You are going to do the investment simultaneously. Right. So in macro PLC, your expected return is, sorry, micro PLC, your expected return equals to 11%. And in the macro PLC, your expected return is equals to 20.5%. Right? 20.5%. Okay. So then here, 50 multiplied by 11 equal to how much? 50 multiplied by 11%. 50 multiplied by 11%. 5.5%. Okay. 5.5%. Then 50 multiplied by 20.5% equals to 10.25. 10.25, right? 10.25%. Totally, you are going to get a return of how much? Huh? How much? 15. 15. Point 7. 5. Right? Clear? 15.75%. And we call this as what? We call this as portfolio, right? Return, right? We call this as portfolio return. Understood? How you got this portfolio return? In a very simple way. Rate that you have invested in micro PLC multiplied by the expected return of the micro PLC. Okay. Then this is the expected the rate that you have invested in macro PLC multiplied by the expected return of the macro PLC. Finally, the answer is this. The amount that you have invested multiplied by the expected return. The amount that you have invested multiplied by the expected return. Expected return. Okay, is it clear? Very simple, right? Rate multiplied by the expected return. Now, this is what I now here you could see this is the formula to calculate the portfolio return. Right? Simply you could say rate of the security X and the expected return of the security X multiplied plus the rate of the security Y multiplied by the return of the security Y. It is the formula. It is the formula. Clear? Right. So now we are moving to the portfolio risk. Now we are moving to the portfolio risk. Now, here, the risk. Now, what do you think about the portfolio risk? Now, if you have done individual investment, that is the only risk that you have. For an example, you pick ABC company and you need to consider about the risk associated for ABC PLC only. Right? But now here you have two companies and sometimes three companies. Right? Two companies, let's for the moment, let's say two companies. Then you have to consider about the returns, the risk of the returns of those two companies. Right? You need to consider about the risk of the returns of those two companies. Right? So therefore, we consider a particular measurement called covariance. Right? We consider a particular measurement called covariance, that is something similar but little bit different than the variance. But the issue is the covariance does not provide a proper answer for you to calculate the movement of these two returns of the two securities, because actually, for you to calculate the risk, you need to know the variance. Right? For you to calculate the risk, you need to know the variance, which means the difference of your return with the mean return. For you to calculate that particular variance for the risk of the portfolio, you need to know the co-movement of returns between the two securities. Right? Co-movement of the returns of two securities, which means when one security performs, what happens to the others? Whether it is also performing or whether the returns of that particular security is decreasing, something like that. Is that okay if I raise this? Fine. Okay. So please provide your full attention to here. Right? Please provide your fully attention now. Right. So now you have invested, you are going to invest in a portfolio. Right? You are going to invest in a portfolio. Return is okay, it's very easy. Now, when it's come to the portfolio risk, right? When it's come to the portfolio risk, you need to know first, right? You need to know the behavior, right? Simply the behavior of returns, right? Of two securities. Behavior of the returns, right? Behavior of the returns. So we call it as co-movement, right? Co-movement of the returns of the two securities. For an example, let's say you have invested in A hospitals, right? You have invested in A hospitals, as well as you have invested in B hotel, A hospital and B hospital, right? So all these companies are having certain amount of returns, right? All these companies are having certain amount of returns. It could be losses or return profits, whatever. So you need to know the co-movement, right? Co-movement of these returns. Co-movement of these returns. Accordingly, you have to calculate something called covariance, but we are not going to do it. Right? We have to calculate something called covariance, but we are not going to do it. It's very simple, similar to the calculation of the variance, but we are not indicating that 2 to the power part there. Clear? Again, get this clear. Think like a story, right? Remember these things like a story, otherwise difficult. Huh? So portfolio risk. So when you are going to estimate the portfolio risk, you need to identify what about the returns. of the two companies. Simply, you need to identify the behavior of the returns of the two companies or two securities. For an example, you have A hospital and the B hotel. Both of them are having returns, either losses or profits. Accordingly, you need to know the co-movement of the returns, right? So for that, we have to calculate something called covariance, right? But this covariance value does not provide a proper interpretation. It's a limitation. It's a limitation associated with this particular covariance. Then we have another measurement called what? What? We have another measurement called, again it's right? What? Huh? Right? Another measurement called correlation, right? Correlation. So how we calculate the correlation? It's simply covariance, right? Simply it's covariance between the security X and security Y divided by the risk of the security X multiplied and the security Y. This is how we calculate the correlation, right? Correlation. Covariance in between the security X and Y divided by the risk of the security X and the risk of security Y. This is how we calculate the covariance. So this provides a meaningful answer about the behavior of the returns of the two securities, right? Behavior of the returns of the two securities. Okay. Right? Whether it is more than one or less than one. So if it is more than one, it's a risky part. If it is less than one, low risky. Low risky. Okay. And it provides whether it is the plus or the negative. Right? Whether the answer is plus or whether the answer is negative as well. Okay, right. Get the practical idea, right? So if it is a risk, you need to measure what about the, you're worrying about the returns, isn't it? Right? You're worrying about the returns. You are going to do two investments together. You need to think about the returns. Definitely returns. The fundamental part. Is this clear? Clear? Okay. Is it clear? Okay. Right? Is this clear for you all? Right. Then what happens is, right? What happens is your answer could be positive or negative, right? Anyway, it have a particular range, more than one or less than one, something like that, right? Okay, so now listen now. Okay, now if the answer says, if the answer of the correlation says, right, there's a there's a positive correlation. There's a positive correlation between AB. Now here we are worrying about AB, A company and B company. Positive correlation. And if the answer is negative correlation, right? These are the three things that could happen, basically. No, or zero correlation. Zero correlation between AB, right? What do you think? Positive correlation means the returns of the two securities behave in the same direction, right? Behave in the same direction. Negative correlation means the return of the two securities behave in opposite direction, right? So this is something like that. This is the returns of company A. This is the returns of company B. Here, this is the return of company A. This is the return of company B. Here it could be this is the return of company B, and this is the return of company B. In a very simple way, right? Because it's simple, two returns move together, two returns move in a different direction, zero correlation. Now, before I explain, tell me if you are an investor. If you are an investor and you are going to do a portfolio investment, which type of securities that you choose, either positive correlated securities or negative correlated securities or zero correlated securities. Zero correlated. Yes. What do you think? Negative or positive? Hands up those say positive. If hands up those say negative. Hands up those who say zero. Why you say zero? Yeah. Why both of you say zero? It's an answer, right? Good answer. Yes.
Different industries. So,
Yeah.
the one impact to one industry doesn't impact to others. So, it's at least research is mitigation in that.
How do you estimate the risk is?
Example,
The COVID period, the hospitals performed well. The hotel industry, economic.
Is that the argument?
Yes.
Then you have to select negative correlation.
no, it's the returning one investment and get the gain in one investment.
Sorry.
Example, the interest rate and the construction industry. So when the interest rates go up, like the construction industry,
Consider about two investments. Don't bring the interest rate part here. Only two investments.
the hotel and patients prices.
Hotel, one industry is hotel, the other industries. Healthcare, okay.
So one go up,
Okay.
one go down.
Then what is that?
Negative.
Negative.
So why investing that, because if we know that hospitals are going down, we can simply shift to something not affected like construction, finance.
Okay, but you prefer to invest. Zero.
There's no.
Okay. Good. So we'll see. Very good arguments, I like those arguments. Okay. So we'll see. Now, positive correlation, would you like? If it performs well, good. But if it goes other way around, it happens. Right? Then the negative correlated, which means if one goes up, other goes down. Even you can predict. Can you predict here? You can't predict. You can't predict here. Because you don't know what will happen, right? For an example, let's say in our house, we have two babies. For an example, let's say we have two babies. Both babies are crying together. Right? Both babies are, let's assume twins. You got twins. Both babies are crying together. Positive correlation. Both babies are laughing together. Positive correlation. So which one we prefer? Usually you would like to prefer, if you are a parent, definitely the second one. Obviously second one. Right? If both kids are smiling, we prefer it. And when one kid is laughing, other kid is crying. Right? If we know it by doing a certain analysis, we can predict. But the other one, you don't know what these two people are doing. Right? As a parent, what do you think? Sometimes you may not be a parent, but feel like a parent. You cannot predict. That's the issue. You cannot predict. So accordingly, since this is a higher risky part, positive correlation, because if both companies perform together, it's good. It's really good. But if it happens in an opposite way, that's the issue. Here, one company performs, other company may be low performing. You can predict, yes.
But the return won't be as expected because let's say one makes 100 million profit and the return for the investment, and the other one makes 100 million loss. So net is zero, so right?
Yeah, it's a special scenario. It's a special scenario, right? But based on these correlation, we have to provide the arguments. Now, if let's take about this zero correlation. Now, your one is correct, right? So no impact, no impact. But the issue is, if other one also get losses, then your entire investment collapse. Here, what happens, Buddha? It's zero correlated, which means you cannot predict. Right? I have just drawn this line now. Just draw this line straight away. Sometimes it could be like this, right? Different angles. You cannot predict what will happen. Without a prediction, would you be able to do an investment? That's the argument. Is it okay? Without a prediction. Now here you can predict. Yes, one could make losses. When that losses, other one could perform. Right? It's a prediction. So you have some sort of a prediction about future, then you go for the investment based on your preference. Clear? But here you cannot predict because the returns of the two securities are not related. You don't know what happened. So get that example, two babies, right? Twins, both are crying, both are laughing. One is crying, the other one is laughing, and we don't know what will happen. Okay, so based on that argument, most of the time we would go with negative correlated assets. Negative correlated assets. Here, this is good, but if it happens in the other way around, that's the issue. This is also okay. What you said is correct. Now here you can have a pattern, but why you are going to invest? If you know that one company is performing and the other one is making losses or lower performing, why you go for that? That's correct. Your argument is correct. But when it's come to the zero correlation, now here the predictability is there. Here the predictability is not there. So you are not going to touch anything without that prediction. Clear? So it's negative correlated assets, right? Negative correlated assets. Okay, right. And we call it as diversified. And finance, these levels. Otherwise, we cannot come up with these things. Doesn't matter what for the leader, even the participants in general. Accordingly, we advise them to go with negative correlated assets. Even to go for this does not mean that you have to select the negative correlated. You can either take positive or you can either take zero. But for the advisory purpose, in finance, we assume that investors are risk averse. We don't like to take higher risk. Accordingly, based on that, we say yes, go with negative correlated. Like if you are a risky investor, you can go with the positive correlated asset, and once you observe that there's a losses, you can sell the entire investment. Doesn't matter. Right? And as we discussed, now you have done an investment in cement industry as well as the construction industry, right? Tokyo Cement and here Market. When the both industries are performing well, you go and invest. So you are earning, you are enjoying higher returns. Suddenly, the lending rate has been increased by the banking sector. So accordingly, you know that it may be a negative impact to the industry. So what you could do is that immediately doesn't matter. It's based on the risk preference, right? It's based on the risk preference, right? Good. Are you okay? Clear? Right. Right. Good. So now, let's read this. Okay. So here it says, can I complete? We explain all these things. Can I complete up to this and let's have a break? Is that okay? Right, because we are discussing about the same thing continuously. Better to complete this, right? Yes, portfolio risk depends on the correlation between the asset, right? Correlation, you know what is correlation? Portfolio risk depends on that, right? So investing wealth is more than one security reduces the portfolio risk because you are going to diversify, right? Diversify. Not in the same industry, different industry. Accordingly, your risk is lower. This is attributed to diversification effect. So the risk is minimized because of the diversification. However, the extent of the benefits of portfolio diversification depends on the correlation between the return of the two securities, right? Simply correlation, right? So when a correlation coefficient of a returns of individual security is perfectly positive, then there is no advantage of diversification. But if you are a risky investor, you can select this. The weighted standard deviation of the returns of individual securities equals to the standard deviation of the portfolio. We'll see it, how to calculate it. Then here it says diversification always reduces the risk provided the correlation coefficient is less than 1. If the correlation coefficient is more than 1, it's a risky, right? If it is less than 1, low risky. So based on that, these are the levels of correlation coefficient that you have, right? So sometimes, right, special situations here that I have mentioned it, your answer could be exactly 1. So it's perfectly positive. Sometimes your answer could be exactly -1. It's perfectly negative correlated, right? So if your answer is 0, no correlation, right? No correlation. And we have positive correlation as well as negative correlation. Right? 0.1 to 0.5 to 0.9, we call it as positive correlation. And the negative aspect, we call it as negative correlation. Negative correlation. Okay. So this is how you calculate the risk of a portfolio. This is the formula. Do I want to give this to the examination? Do I want?
Yes.
Huh? It's easy, right? No need. Okay, I'll give it. Right? Okay, so after the break, we'll calculate the portfolio risk. So you can have your break for 20 minutes. So please be here at 10:50. Yes, online students, are you all okay with this? Is it clear? Online students?
Yes, sir.
Okay, fine. We'll have a break and we'll meet at 10:50. Yeah?
Okay, thank you, sir.
Right, okay, we'll start again. Yes, online students, are you all there? Online students, are you all there?
Yes, sir.
Right, okay, now we can do the calculation for a portfolio risk. We can do the calculation for a portfolio risk. I think you all can see the document that I have shared. Right, okay. Question number 3. Right, so what we have to do. Right, question number 3. Yes. Now you have to calculate the portfolio risk. Right, you have to calculate the portfolio risk. Right. You have to calculate the portfolio risk. So here it says Mr. Peter has two investments in HFC PLC and JKH PLC, which are guaranteed to offer him an expected return of 24%, 19% respectively. The risk of the two investments are estimated at 28% as well as 23% respectively. So which means there are two investments, HFC PLC and JKH PLC. Both expected returns have been given as well as both risk of the individual investments have been given. Then the correlation between the two securities have also been given. What do you think? Is it a positive correlation or a negative correlation? Positive correlation, right? So it's 0.6. So what you have to do, calculate the risk of the portfolio combined with equal weights. Sometimes the weights could be different. You can identify it, right? So with equal weights, right? So let's see how we could do this. Right now, you could think this is the formula, right? This is the formula, right? Here it says weight of the security one, right? 2 to the power of the weight of the security one multiplied by the risk of the security one. Here again, this entire part tells you about the security one. This part tells you about the security two. Simply the weight and the risk. Weight and the risk. Then you need to mention the correlation between these two securities. The correlation that we discussed earlier before our interval. Because correlation captures the movement of the returns between two assets. Accordingly, you got to know that portfolio risk depends on the correlation between the returns of the two assets. So we need to incorporate that one as well. Now here in this question, the correlation is positive. Accordingly, this is positive. If it is negative, this must be negative. Right? Multiplied by weight of the two assets multiplied by risk of the two assets. Then you need to get the square root of it. Right? Then you need to get the square root of it. Okay. Right. So we'll do this. Now here the assumption is weight is same, which means 50%. Right. Weight of company 1 is equals to 0.5 multiplied by the risk of the company 1 equals to how much? In the question, risk of the company 1 equals to 28%. 0.28. Clear? Right? Within brackets. So this is entirely about your investment one. Right? Then plus. Here the weight is again same. Multiplied by the risk of the second investment is 20. 23. Right? 23. Up to now, are you all okay? Fine. Then plus the correlation between two assets. Now next variable is correlation between the two assets. 2 multiplied by the correlation between two assets. How much is it? 0.6. Right? So it's plus, right? 2 multiplied by 0.6. 2 multiplied by 0.6. Okay. Then multiplied by weight of the security 1 and weight of the security 2. This is the weight of the security 1 multiplied by weight of the security 2 multiplied by risk of the security 1, risk of the security 2. Okay. Simply, you need to get the square root of this. You need to get the square root of this. Yes, how much? Online students, what could be the answer? Yes, online students. Yes, how much?
0.58.
0.58. Oh, 58% puta. 0.58% to 58%. Yes, what about your answers? Right, so now here let's say 0.5 to the power 2 multiplied by 0.28 to the power 2. What is the answer that you're going to get here? Huh? Let's go one by one. As a group, let's go one by one. Without looking at the final value, we'll start from the beginning. Okay, yes, what is the value? Here, this must be same for everyone, now. 0.019. 196. Right, okay, then here. Is this correct for you all? Okay, good. So what about this? Yeah? 0.0 0.0132. Is this correct for all of you? Correct? Then here. Yes, here. Answer. Well, what is it? How much? 0.0193. Okay, right, it's plus. So what is the answer? I mean the value. Hmm?
0.0525.
0.052
0.52.
0.
No, 0.052.
Okay, 0.052. Right. So we get the square root of this. Then what is the answer? 0.2228, which means 22.8%. Okay, online students, did you get this answer? Okay.
Yes, sir.
Okay, fine. So this is the portfolio risk, right? Portfolio risk. In a very simple way, you are going to get the weight and the risk of one asset, weight and the risk of another asset, then the correlation, then the weights and the risk of individual assets. Right. So the portfolio risk is this. Clear? Your presentation starts at 1 o'clock, isn't it? On the block. So is this clear for you? Right. Now, what are the things, if I wrap up the things on today's discussion, risk and return, it's a very easy lesson, right? You will be given the equations for the portfolio return as well as the portfolio risk. No other equation will be provided. At the very beginning, we understood the importance of this risk and return concept, right? Then we started discussing about types of returns. In there, we learned usual return, which comprises with your dividend yield and the capital gain yield. Then the other one is average rate of return. Simply you're dividing your entire returns by the number of years of the sample size. Third one is your expected return, where you multiply the each return component with the probability to arrive at your expected return, right? Then we calculated the risk of the individual securities, that is by using standard deviation. But before that, you have to calculate the variance. So you got to know the exact meaning of variance and how to calculate the variance, then how you derive the risk or the standard deviation from the variance. Okay, then we discuss about something called this normal distribution as well. Then we started discussing about portfolio risk as well as portfolio return. So at the very beginning, we understood what is a portfolio, right? Then how to calculate the portfolio return, then how to estimate the portfolio risk. So you got to know that when we are going to estimate the portfolio risk, it depends on the correlation between the returns of the two securities. So simply you need to identify the behavior of the co-movement of the returns of the securities. So for you to identify the co-movement, we have to calculate something called covariance, but we didn't do that calculation covariance. It doesn't provide that much of information for an investor of the strength of the answer. Accordingly, based on the covariance, we have to calculate a particular measurement called correlation, where we use the covariance answer and we divide it by the standard deviation of the individual securities, right? Individual security. So then we are going to get an answer called correlation. It simply measures the relationship between the returns of the two securities, right? So you may get positive values or you may get negative values. So based on those, you may have something called perfect correlation, negative correlation, as well as zero correlation. Sometimes you may have, if you got the exactly answer, -1 or +1, we call it as perfectly negative correlation. If you got exactly -1, if you got exactly +1, we call it as perfectly positive correlation, right? Then when it's come to the finance, we believe that investors are risk averse. Accordingly, we are suggesting to go with negative correlated assets. So we have a very good discussion about this positive, negative, as well as zero correlation assets, basically the diversification. Right, you are not putting your all eggs in the one industry, but in a different industry and also different industries, different securities. Right, diversification. So then we finally calculated the risk of a portfolio as well. Right. Now we are going to look at something called the capital market line. Right, capital market line. So we'll see what is that. Right, capital market line. Right. Okay, now before you going to learn about what is called a capital market line, right? Don't read anything up. Don't read anything. Just we'll discuss certain practical things up. Now you have something called a capital allocation line, right? You have something called capital allocation line. Okay, capital allocation line. Now, if you, let's say there are 40 students, for an example, let's say there are 40 students in this class, and the expectations about the returns and the risk of certain investments are different from each and everyone, because you perceive about a particular investment in a different way, right? So the same investment, but could be different ideas. For an example, let's say you are going to invest in company A. Some believe that it may generate this much of a return for the risk that they bear. And some believe that the company could generate this much of a return for the risk that they going to bear. So accordingly, you may have different perceptions about the return and the risk about your investment, right? And you may have different amount for your investments as well. Okay. So when it's come to the capital allocation line, right? What happens is usually the portfolio managers, right? So they can draw individual capital allocation lines to each and every investor. individual capital allocation line. So this simply tells you the return and risk of the portfolios, right? Capital allocation line, if you look at the axis, right? If you look at these two axes, it simply says the return and the risk of the portfolios, which means all these points are your portfolios, right? Portfolios. The risk and return relationship is illustrated in a portfolio by using this particular two axes, right? So accordingly, such person can allocate different portfolios for you depending in your risk preference as well as return preferences. Accordingly, if there are three persons, you may have three capital allocation lines, right? Three capital allocation lines starting from your risk-free return. This is the base, right? Starting from your risk-free return because government security offers this much. Yes, you are starting from there. Hope you could remember when we discussed about the capital asset pricing model. We discussed about it, right? So here you have your return, portfolio return, and the beta. It's risk. Beta simply is your risk, right? Or you can just mention standard deviation. Anyway, it's risk, right? Anyway, it's risk. So three personalities are there. They believe, they think about their investments in a different way. Accordingly, one particular investment manager can draw three different capital allocation line for these three persons. Okay. So we call it as capital allocation line. How you are going to allocate your capital. Right? How we are going to allocate your capital. So if you prefer this, if this is your portfolio, which means you are bearing this much of a risk, and for that risk, you are going to get this much of a return. Right? We call it as a capital allocation line. Capital allocation lines. Clear? Right. Then, for our easiness, we have something called a capital market line. Right? Capital market line. So here we believe that investor perceive about certain investment in a same way, right? To develop a particular theory, right? So accordingly, you may have a one line because you think about in the same way, right? You think in a same way. If you think differently, you may have different capital allocation line. But if you are going to think in a same way, you have a one line. So we call it as capital market line. Okay, capital market line. Right. Okay, shall I erase this? Right, capital market line. Right. Now, you could see this. This is the return of the portfolios, and this is the risk. So let's say this is your risk-free return, right? And you have some line like this, some line like this. Right. Now, this is portfolio A, right? This is portfolio A, and this could be your portfolio B, right? And this could be your portfolio C, portfolio D, and portfolio E. Okay, different portfolios, right? Now, let's say you have another portfolio here called Z, right? Z. So you can understand this is the risk and this is the return for each and every portfolio. Clear? Right. Now, if you look at your portfolio A, right? If you look at your portfolio A, it gives you this much of a risk. Clear? It gives you this much of a risk. Simultaneously, it gives you this much of a return. Okay. You really observe this graph, you could see you are going to bear same risk, but you are going to get a higher return from another portfolio. What is that portfolio? Huh? Portfolio C. Clear? Portfolio C, which means both are in the same direction. You are going to bear the same risk, but portfolio C offers you a higher return than portfolio A. So which means you are preferring C than A. Right? You are preferring portfolio C than portfolio A. Right? So this is better than this portfolio. Clear? Right. Then if you look at this part, here you are bearing a particular risk, and for that you are going to bear a particular return for that as well. Then again, you could see there is another portfolio gives you a higher return for the same risk. What is that? Portfolio B. Very good. Portfolio B gives you a higher return for the same risk. Accordingly, you prefer portfolio B than portfolio Z. Okay. So likewise, we can draw many portfolios here. Right? Now here, all these portfolios are good because you don't have anything. Even though you have here certain things, these portfolios are good. Right? Okay. So starting from here, all these portfolios are efficient. Right? We call these as efficient portfolios. Right? We call these as all these portfolios are efficient. All these portfolios are efficient portfolio. Right? Efficient portfolio. Here also efficient portfolio. This also efficient portfolio. Clear? Efficient means what? You are going to get a higher return for the risk that you bear. Right? You are going to get a higher or a fair return for the risk that you are going to bear. Accordingly, it is efficient. Clear? It is efficient. So you observe that we drew a line by connecting all these efficient portfolios. Clear? We drew a line by connecting all these efficient portfolios. So accordingly, we call this as efficient frontier. Right? Efficient frontier. Okay. Good portfolios are efficient portfolios. Line connecting all those good portfolios. So efficient portfolios are known as efficient frontier. Clear? Good. Right. And you may have observed that certain pictures are having like this. We go there, forget about it. Right. Is this okay up to now? Okay. So what are the new things that we have learned here? Simply it illustrates you the risk and return relationship between portfolios. One portfolio could be preferred than another portfolio. Such portfolios are individually known as efficient portfolios. If you draw a line by connecting all those efficient portfolios, we call it as efficient frontier. Right? Efficient frontier. Right. And this is your EML or capital market line. EML or capital market line. Right? EML or capital market line. Online students, are you okay with this? Is it properly visible?
So the low part is not much visible, sir. Above the line,
Yes, which line?
which you have mentioned the good points.
Sorry, Uda, I didn't get you.
Which you have written above the line, sir. It is not visible.
These are efficient portfolios efficient portfolios, efficient portfolios. Okay, fine. Right. Okay. So this is about your capital allocation line, capital market line, then efficient portfolios and efficient frontiers. Okay. Right. Now, you observe that, right? You observe that. Okay. Still, you haven't observed. If you look at this particular graph, right? If you look at this particular graph, you could see there's a particular point where your efficient frontier touches your capital market line. Right? Your efficient frontier touches your capital market line. Right? So we call that particular point as optimum risky portfolio or market portfolio. Right? Optimum risky portfolio or market portfolio. Right? Optimum risky portfolio or market portfolio. That is the maximum that you could go based on the available wealth of you. So it consists with both risk-free securities as well as risky securities. Right? So this part consists with both risk-free securities as well as risky securities. Here you have done an investment in a risk-free security. After that, it's all about your risky securities. Right? So your market portfolio consists with risk-free securities and risky securities. Risk-free securities as well as risky securities, and that is the maximum that you would go. based on the available wealth of you. So that is the point, tangent point, right? The point that connects both C and L, and this particular efficient frontier is known as market portfolio or optimum risky portfolio, right? Market portfolio or optimum risky portfolio. Optimum risky portfolio. Market portfolio or optimum risky portfolio. Okay. The maximum that you could go based on the wealth that you have, based on the wealth that you have, based on the wealth that you have. Okay, right. Now, what actually happens with that? If you go and invest in a government security, right? If you go and invest in a government security, what actually happens? Simply, you are providing a loan to the government. Am I correct? Am I correct? If you purchase a treasury bill or a treasury bond, you are providing certain loan. Am I correct? Right? So your history security consists with that. You are lend money to the government. And after that, you investment in companies. Right? You invest in companies, you are not providing the loan for the companies. Right? So it's simply you are invest in a companies. Accordingly, this particular range, we call it as lending portfolio. Right? Lending portfolio. Right? The phase in between your history security as well as the market portfolio, we call it as lending portfolio. Lending. Clear? You lend money to the government plus you invest in companies. Right? You invest in companies. Either it could be IPO or secondary market investment. Right? If you go for IPO, you are providing again particular facility for the company. But if you go for a secondary market, it's you are not providing any facility for the company. Right? You are supporting the liquidity of the country. Right? So we call it as your lending portfolio. So I told you that this is the maximum that you could go based on the available wealth. But if you want, you can obtain a loan from a bank and you can further invest. Right? You can obtain a loan from a bank and you can further invest. Accordingly, this part is known as borrowing portfolio. Right? Borrowing portfolio. That's what you don't have any calculations for this. Right? Because return changes. If you borrow and invest, return changes. Lending portfolio and the borrowing portfolio. Right, so that is what here it says. In between, this is the tangent point. In between here, it's lending. After this point, it's borrowing. Right? After this point, it's borrowing portfolio. Lending portfolio and the borrowing portfolio. Simple, right? So here you have something called minimum variance portfolio. There is something called minimum variance portfolio. If you look at P portfolio, we can consider it as minimum variance because the variance is minimum. Right? Because the variance is minimum. Can I ask a small question? Now, this is the starting point. Right? Actually, this is the starting point. Why this curve Suppose this, I mean, why there is a backward trend? I mean, backward, but increasing trend is there. It goes back, but increasing. Why? Let's say, earlier you were in A, now Z. Why is that? Why it can't be like this? Why it can't be like this?
So the market capital, they have to reach the market capital.
Market capital means?
The capital.
Yeah. Okay, anyway, but why? There must be a practicality here.
Fund to reach that.
No, there's a practical reason, nah? But very good thinking. Anyway, you have reached this, isn't it? It's a different story, but practically, yeah, you are reaching there, but you can reach it like this, though. But why? Why? Hmm? Sorry?
In the initial stages, we mitigate the risk.
We mitigate the risk. How?
By investing in
Mitigating
a
how? Mitigating risk is correct. How? Huh? Yeah. Go on. Investing. Yeah.
in a low risk
Invest low risky companies. So investing in good companies. We are using a particular name for that.
Diversity.
So here you could see the diversification effect. This is the diversification effect. Right? Earlier you have invested in company A, but now you have decided to diversify. Go for another industries. Accordingly, Buddha, you could see your risk is lower, right? Risk is lower. Simultaneously, return increases, right? Return increases, diversification effect. If you go for a diversification, risk minimize, return increases, right? Again here. But what happens after this point? Yes, you have to face for the risk, but the return is high, right? Even though it does not mean that if you go for diversification, the risk is zero, risk is too minimum. The risk is minimum, right? But the return that you get is high. Now here, this is the diversification effect, direct diversification effect, right? Risk is minimum, return is high. But when you diversify more and more, yes, your risk is distributed and the return simultaneously increases. Return simultaneously increases. Okay, is this clear for you all? If this is clear, don't read this. Right? If this is clear, think it like a story, right? I have indicated certain things because there must be a note, no? Right? Because the best way of understanding this particular aspect is practically explaining this. Otherwise, not. Otherwise, not. Right? Okay, so what are the things that you have learned here? At the very beginning, you learned something called capital allocation line. Can you remember? Different investors perceive different way about the return and the risk. Accordingly, if you pick 3 investors, we can draw 3 capital allocation line. How their funds can be allocated. Capital allocation, how their capital can be allocated. Right? Capital allocation line. But for the assumptions, we assume that it's okay. Then we are coming up with something called capital market line. Right? So this is the capital market line. It simply shows the relationship between the return and the risk, or return and the risk of portfolios. Return and the risk of portfolios. Then we draw a particular line. I have explained all of these things. Then sometimes you are bearing same risk, but one portfolio offer you a higher return, then you prefer that portfolio than this. Here, you prefer portfolio B than portfolio Z. So all these portfolios gives you a higher return for the risk that you bear. Accordingly, we rename all these portfolios as efficient portfolios. And the line drawing by connecting all these efficient portfolios are known as efficient frontier. Efficient frontier. Okay. There are certain things feasible set. Okay. Then there's a particular point where your efficient frontier touches the CML, capital market line. We call it as optimum risky portfolio or market portfolio. Why? It combines both risk-free securities as well as risky securities. Right? It combines both risk-free securities as well as risky securities. Then here we can divide the entire line into two parts. This part, what happens? You have invested in government, which means you lend your money to the government. Simultaneously, you have invested in companies. Accordingly, we call that part as lending portfolio up to this point. So this is the maximum that you could go based on the available funds in your pocket. Okay, but still you could go. You can borrow and invest. No worries, right? So that part is known as we commonly call it as borrowing portfolio, right? Borrowing portfolio. Okay, this is clear. Can you answer any question? Any question in your paper? Diversification effect. Diversification effect. So the final one that we done is how to illustrate the diversification effect. Right? Diversification effect. Risk is minimum, return increases. After that, this curve again move to the same direction because you are bearing a risk and you are getting a return. You are going to get a return. Okay, online students, are you clear with this? Online students, are you okay with this?
Yes, sir.
Yes, sir.
Right. Okay, so the final part. We are moving to the security market line. Earlier, it actually nothing to teach. We already discussed about this category, right? Security market line. Now you have two types of market lines. One is capital market line, where it shows the relationship between risk and returns of portfolios. And the other one is security market line, where we consider about the individual securities, expected return and the risk. Right, so hope you remember that when we were discussing about the cost of capital under the capital asset pricing model, I have explained this capital asset pricing model. Right. See, expected return is equal to risk-free rate plus beta into market return minus risk-free rate. Right. Beta measures what? Huh? Which risk? You have two types of risk, systematic risk and unsystematic risk. Beta measures systematic risk. Volatility of the company returns with the returns of the market. Right? Returns of the market. Simply, you are going to get the covariance between your return and the market return. Then you are going to divide it by the variance of the market portfolio. Right. So here you could say, if you look at the CML, sorry, it's capital market line. Actually, sorry, this must be security market line. SML, SML, security market line. Please make that correction. Excuse me, sorry, security market line. Right. So the combination of the expected return points with the risk associated with this, we call it as capital market line. Hope you remember that I have explained it in a very proper way, if I'm not mistaken, when it comes to this cost of capital. This is your risk feasibility. Then what happens if you go for a corporate bond, then preferred shares, ultimately equity, right? Ultimately equity. The slope of the security market line is the sensitivity of the coefficient is referred to as the beta. Simply beta means that slope of your security market line. Slope of the security market line. That's it. So come to the examination and last. Okay. So this is the end of your risk and return lecture. Now we are going to. Right. So now, if I wrap up the things, right, about your risk and returns, please check whether you're okay with these things, right? So again, I think I'm telling this for the third time, right? So first, we discussed about the importance of risk and return in terms of valuation as well as in terms of investment, right? Because we are mainly talking about the risk, right? Willing to unwillingly or considering both risk as well as the returns. Thereafter, we discuss about the types of returns where we consider about dividend and the capital gains. And the other one is average rate of return. Simply, you are going to divide your entire return series by example. Then you have the historical returns and the expected return. So when it comes to the expected return, we calculate it based on the return multiplied by the probability. Why? Because it's future expectations, right? Probability. Then you are going to get the expected return. After that, you got to know how to calculate the risk of an individual security. It's based on the standard deviation. Before calculating the standard deviation, you have to calculate the variance. You got to know the exact meaning of variance and how to calculate the variance with the probabilities. If you have been given the past data, you have to divide it by n-1. If not, keep it as it is. Right? Then, after calculating the variance, we get the square root of the variance. Then thereafter we calculated the risk or the standard deviation of the individual investment. Then we started discussing about portfolios. Right? If you have more than one investment, no need to be a security. It could be any type of an investment. Right? Only a security. Even though if you have two bank accounts, it's a portfolio. If you have a two bank account, it's a portfolio. Right? Yes, portfolio we calculated. Basically, we are going for a portfolio to minimize the risk. Right? So how you calculate the portfolio return? Base multiplied by the return of a particular company. Then base multiplied by the return of the another company. It's very easy. You will be given the formula as well. Though it is easy, you will be given the formula. Then we started discussing about the portfolio risk. So portfolio risk depends on the movement correlation between the assets, right? So we need to look at the behavior of the returns of the two securities. For that, first we have to calculate something called covariance, but the answer does not provide any value additional interpretation. So accordingly, based on that answer, we are calculating something called correlation, right? Which exactly measure the strength of the relationship by assigning positive and negative values. So if the answer is exactly 1, we call it as perfectly positive. If the answer is exactly negative, we call it as perfectly negative. So otherwise, we may have perfect positive relationship, negative relationship, or zero correlation. Right? So when it comes to the finance, we assume investors are rational. Accordingly, we just say if you are going to invest, better to be negative correlated asset because one performs, other costs, the risk would be, the losses would be minimum. But based on your risk preference, because if you look at investors, risk seekers are there, we call them as risk lovers, right? Then risk neutral investors are there, and the other investors are, we call them as risk averse. So usually we believe that investors are risk averse. Accordingly, investment advisors they provide yes, better to go with negative correlated assets, but based on your willingness, you can either choose whether to go with positive correlated or zero correlated. And it entirely depends on your strategy and the type of handling your investment. Clear? Right. Then you got to know how to calculate the risk of a portfolio. You will be given the equations as well. Thereafter, we started discussing about this CML and SML, capital market line and security market line. So before we consider about this capital market line, we discuss about what is capital allocation line. Then we came back to capital market line. India, you got to know how to identify the efficient portfolios, right? Then what is efficient frontier? Then what is market portfolio or risky portfolio, right? Then what is the meaning of this minimum variance portfolio, right? Then lending portfolio, borrowing portfolio, diversification effects. Why this curve goes like this? Why can't it be like this way? Everything done. Finally, security market line, we've already discussed this part, and simply it tells you the risk and return relationship between individual securities. So that's all about your risk and return. So definitely you have a question in your paper for 18 marks from this risk and return. So you need to know the theory, you need to know the calculations. Mainly, you need to know how to interpret the results. Interpret the results and come up with a decision whether to go with that security or not. There is from the valuation also, calculation, theory, and decision making. Right. Okay. So that's the end of today's session. Yes, online students, any doubts, Putala? Any doubts that you need to clarify? Any doubts? Online students?
No, sir.
What else? Yes, online students, are you all there?
Yes, sir.
Alright, yes, there.
Yes, sir.
Any doubts?
No, sir. It's okay. Clear.
Okay, fine, fine. Right, finally, now you have, I think, completed one of your group activity. I will upload the second group activity. Simple questions on capital budgeting. Then those two assignments are over. Then the final assignment will be submitted on the final date. Do you have presentations? Okay, so you don't have presentations, just only the submission of the assignment, and we have only one lecture. I mean, one topic to discuss, that is working capital management. Very easy. So if you look at the entire package, finance package is easy. The finance package is easy. Right? Okay. Thank you very much, finance students. See you on next week. Goodbye. Take care. Stay safe.